On April 22, 2026, the market did something that looked almost contradictory. The S&P 500 jumped 1% to a record 7,137.90, and the Nasdaq climbed 1.6% to a record 24,657.57, even as Brent crude settled above $100. What investors cared about most was simple. Strong earnings mattered more today than the latest spike in oil. This was not a narrow one-stock move. The Dow rose 340 points, GE Vernova gained 13.7%, Boston Scientific rose 9%, Boeing climbed 5.5%, and Philip Morris added 7.0%. So the market was not ignoring risk. It was rewarding companies that kept posting better numbers than analysts expected, even with the Iran war still driving oil and headline risk. That is the best way to frame April 22nd. A little more than 15% of the S&P 500 has reported so far. Even at this early stage, if the rest of the index merely matches estimates, first quarter earnings would still come in roughly 14% above a year ago. That helps explain why stocks can keep pushing higher even when gas is expensive and headlines stay ugly. Profits have been strong enough to keep buyers engaged. GE Vernova was one of the clearest examples of what the market wanted to see. First quarter orders jumped to $18.3 billion. Revenue rose to $9.3 billion. The company also raised its 2026 guidance. More important than the headline beat was where the demand came from. Its electrification business booked $2.4 billion of equipment orders tied to data centers in one quarter, more than it booked in all of last year. That matters because it shows the AI buildout is spreading beyond the usual chip story. Investors are no longer looking only at who sells the compute. They are also looking at who can deliver transformers, switchgear, and the rest of the power hardware needed to keep those data centers running. When a power and grid supplier becomes one of the best performers on the tape, that tells you the next bottleneck is shifting outward. Google added another piece to that puzzle on Wednesday. At Cloud Next, it introduced two new TPU chips, TPU-8i for fast customer-facing AI tasks, and TPU-8t for training larger models with a massive shared memory pool. The important part is not just the product launch. It shows the cloud race is getting more specialized, with one system built for live use and another built for heavy model training. That fits a broader capital spending backdrop. Microsoft said in its fiscal first quarter call that it expects total AI capacity to increase by more than 80% this year, and that it is roughly doubling its data center footprint over the next 2 years. Put that next to GE Vernova's orders and Google's TPU split, and the picture gets clearer. AI spending is still alive, but the winners may be broadening. None of that erased the geopolitical risk. Brent crude rose 3.5% to $101.91. Earlier in the day, it briefly traded above $102. Iran fired on 3 ships in the Strait of Hormuz and seized 2 of them. The United States kept its regional blockade in place even after extending the ceasefire. So the energy shock never left the screen. It just failed to overwhelm the earnings story before the closing bell. That balance is important. Oil above 100 is not a side note. If it stays there, it can squeeze corporate margins, lift transport costs, and chip away at household spending power. In other words, the same market that rallied today can still get hit later if the oil shock lasts long enough. April 22 was a reminder that stocks can climb while the risk underneath them is still very real. There was also a clear warning sign out of Europe. Germany's ZEW Economic Sentiment Index fell to -17.2 in April. Euro area consumer confidence dropped to -20.6, its lowest level since late 2022. Germany also cut its 2026 growth forecast to 0.5% from 1.0%. So while U.S. equities pushed to records, Europe was still moving the other way on growth confidence. That gap matters because it helps explain why U.S. stocks can look strong without the global backdrop being clean. The United States is benefiting from a powerful earnings cycle and still heavy AI spending. Europe is dealing with the same energy shock from a weaker starting point. So the market is not telling you that the macro risk is gone. It is telling you that, for now, U.S. profits are outrunning it. After the close, Tesla gave the market another after-hours earnings signal. First quarter revenue came in at $22.4 billion, with $477 million in GAAP net income and $1.44 billion in free cash flow. The company also said Cortex-2 is now online and running training workloads. That keeps Tesla in the same conversation about AI and infrastructure, but it also means Thursday's market will have fresh after-hours earnings reactions layered on top of the oil story. Taken together, April 22 looked like this. The market hit records because earnings stayed strong and the AI buildout kept widening, not because the geopolitical risk vanished. Oil is still high, shipping risk in Hormuz is still live, Europe is still weakening, but profits have been good enough to keep the rally intact. The next watch list is straightforward: earnings breadth, Brent's direction, and whether AI infrastructure winners keep leading.